Hey everyone. I was reading an article in the Wall Street Journal a couple weeks ago and I thought it'd be interesting to talk about. It was an article about a few investors who lost almost all of their retirement savings in just a matter of a couple weeks. We've heard stories like that, but it's like, how does that happen, So what they did, they invested in a risky product called an exchange-traded note, highly leveraged, not to be confused with exchange-traded funds that we hear so much about. Exchange-traded funds are like mutual funds, but these exchange-traded notes are different. What they are is that they're basically debt instruments or a bank or brokerage that offers to pay you the return of an underlying index. The difference between these risky products is that they actually don't own the index or anything other than options and complicated derivative products. And then they borrow so that they can give you X times the return of the underlying index. So, if it's a stock index and the S&P went up by 1% during the month, they would pay you 2. But let's say if it went down, say 10% in the month, you would lose 20%. So you can see how losses and gains are magnified. And as long as things are going good on the upside, that's a really sweet deal because you're getting, multiple times the market return. The problem is that when we get into a financial crisis like we just faced in March, a lot of these underlying indexes, they can invest in almost anything like stocks, commodities, real estate, mortgage REITs, and currencies, you name it. If it has an index, it could have an exchange-traded note following it. And so the problem became that when the market came crashing down, oil prices tumbled, the mortgage interest was not being paid due to the pandemic. And so a lot of those leveraged notes that were investing in these kinds of indices started to lose multiple times. Now, not only did they just lose significant amounts like you might have in the stock market. So we went down, I think 37% was the high. We're already back now, have recovered to about 16, 10%, somewhere in that range. But yet these have now lost almost everything. They're almost down to zero. So UBS has already redeemed or closed, liquidated about 15 of their 40 funds. And that means that some of these investors like William Mark or James Zhu, Brad Davis, who were all featured in the article, these people invested their retirement savings in these vehicles, trying to catch up after the 2008 and 2009 crisis. They jumped out, didn't ride the recovery back up, sat out a few years, missed a good chunk of the recovery, and then they're trying to jump back in, and they were allured by these high returns offered by these leveraged notes. And they were told these are less volatile than equity securities, they're consistent, stable, and they pay higher returns than bonds. What they didn't realize and what they didn't understand was the complexity of the leverage. And crisis events, like we're experiencing now, could wipe out investments like this. That's what they didn't understand. See, professional investors, professional advisors who understood the products stayed away from them. It was the do-it-yourselfers really didn't understand, didn't know how bad they could get hurt, that jumped into the lure of the investment pornography being pitched by banks and brokerage houses. Remember this, in financial markets, there's no such thing as a free lunch. High returns always come with high risks, always. There's no exception. You can't get a risk-free return. It's a well-worn phrase. If it's too good to be true, it probably is. Well, well-worn phrases are well-worn for a reason. they have a lot of truth embedded in them. And experience teaches us that. So next time you're tempted, you see something that sounds too good to be true, that you're being lured by some promise of high return and little risk, please call a financial advisor. Ask them to take a look at it before you jump in, and make sure the financial advisor has the credentials, enabling them to be able to adequately assess the risks of the underlying product. Well, until next time, stay safe and live healthy.